welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Renewed optimism among investors on hopes that higher prices may have peaked has quickly vanished. Red-hot inflation numbers out of the U.S. all but guarantees that both the Bank of Canada and Federal Reserve are not done hiking rates to fight inflation, even if it hurts economic growth. Joining me now with his thoughts is Sebastien Mc Mahon, Chief Strategist at IA Financial Group. Sebastien, great to see you again.
Hey, great to be here.
You know, it was interesting because we started to see enthusiasm on the part of investors, and they thought that, hey, maybe inflation has peaked and it's trending down. Not so fast, right?
Yeah, exactly. And the Federal Reserve has been very clear on that, the Bank of Canada too, that, they need to see broad evidence that they're winning the fight against inflation before they can even stop about thinking to stop hiking rates, and even at some point, pivot towards maybe lowering rates when needed. And we're not there yet. We're still seeing a broadening of the inflation pictures, meaning that there are more and more components that are rising at 3, 4, 5% year over year. And it's good to see gasoline prices fall down a little bit here, which is, of course, has a huge footprint on the CPI number. But now the focus is turning very squarely on services inflation.
Yeah, so let's talk about that, Sebastien. When you dig into the inflation numbers, and I'd say both sides of the borders, how are you reading it? What are some of the particular things you're noticing?
Yeah, well, we see that inflation is going to be likely stickier than most market participants seem to be thinking recently, at least. So when you look at goods inflation, you're starting to see it come off because of the price of gasoline. It's been helping that the U.S. has been, taking some stock out of their strategic reserve just to help, with the supply in the market, helping pushing the price of oil lower. Strong U.S. dollar also helped pushing the price of oil lower. So that helped the goods component. But when you look at the services component, this is tightly linked to wage pressures, to wage expectations. And if we'll make a parallel with the 1970s and early 1980s, we had two episodes where inflation was very strong. And in both episodes, we had the goods component peaking about 1 or 2 years before the services component. And on both occasions, it took a recession to break the back of inflation. And it's not a coincidence that central bankers, especially in the Fed now, they're quoting Mr. Volcker a whole lot. They're trying to avoid the mistakes that were made under Ultra Burns. So the mindset of the Fed now and of the Bank of Canada is they need to fight to the end.
So when you say services, it is related to wages?
Yeah, exactly. So services, think about restaurants and hotels, and the price pressures in services is tightly linked to the labor market and to wages. So the hotter the economy, the hotter the labor market, the hotter this will keep on, and the higher the risks that we have persistent inflation because with the anchor inflation expectation. So this is now the fight for the coming quarters.
Sebastien, it was previously, there was a lot of talk about the supply constraints, right? Even though some of it was demand-led as well. What's happening on the supply side then?
On the supply side, we're starting to see good things. We're starting to see the imbalance between supply and demand resolve itself. We're starting to see waiting times that are falling for suppliers. We're starting to see shipping costs that are also moving lower. So this part is not completely resolved, but it's well into its resolving process.
Okay. Sebastien, we have another chart, the global PMI versus the global monetary policy, and we're going to bring that up. Explain what you're seeing here. We have about a minute to the break.
Yeah, sure. So the global PMI is pretty much the global economic cycle. So the blue line that you're seeing here, this is the strength of the global economy. So of course, it's a cycle, it goes up, it goes down. And the red line is our proxy of what's going on with monetary policy. And the lower the red line, the tougher it is for the economy to grow because financial conditions are getting tighter and tighter. And as you can see, the red line leads the blue line by about 11 months here. So what this is suggesting is that the impact of tightening monetary policies around the world is negative on the economy now, and it should get even worse as we move through 2023, making 2023 a real transition year where we could see a softer global economy. And maybe this will be enough to help with the inflation picture, but expect some economic pain to succeed in the fight against inflation.
All right. And I should mention the PMI, it shows a trend of the manufacturing services industry. Sebastien, we're going to take a quick break and we'll continue this conversation. Welcome back. Sebastien, the other economic data, I guess, to take note of is that the unemployment figures are creeping up here. What can you tell us about the job picture in Canada?
Yeah, the job picture in Canada remains very good when you look at the employment rate, so the percentage of the population that is working for the 25, 54 years old, so the core of the labor force. It's still at close to an all-time high. So Canadians are working. The participation rate is very high too. So we have a good situation here. In the US, it's a bit different. They're working very hard to bring the participation rate up. Seems to be working recently, but Canada's labor market is way ahead of the one in the US. Of course, that comes with wage pressures and labor scarcity that are going to be issues probably for the next few years. So the picture for employment is good, although we did see unemployment tick up a little bit in the latest report. That had to do with some losses in jobs over the last 3 months. But remember that we regained all of the jobs that were lost during COVID last October. And in the US, it was just this summer that we reached that. So maybe we're a bit ahead of the cycle that we see in the US.
Okay. One of the things that you've noted, Sebastien, is that Canada's economy has become very sensitive to interest rates, especially relative to the US. How?
Yeah, sure. So when you look at the components of GDP, you see that the residential investment component now is at 10%. So Canadian GDP is roughly $2 trillion a year. So 10% of that is $200 billion a year that's linked to residential investment. And when people think about residential investment, we tend to think about construction first and then maybe renovation. But ownership transfer costs are also almost as equally important. So the volume of transaction is very important here. So now that we've seen a lot of tightening from the Bank of Canada, there's more to come. Likely we end the year at about 4% on the leading rate. So there's a few more rate hikes to come. Well, as we've seen that, we're seeing the housing market become slowly but surely a buyer's market. We're seeing fewer transactions. We're seeing less activity. So that puts the economy at risk, because if there's less construction, of course, this is a direct hit to GDP. But if there's less volumes of transaction too, there's about 2-3% of GDP that's at risk here.
We just brought up that chart, the residential investment. What's driving that here? And what I mean by that, Sebastien, is it because Canadians in general are carrying more debt and I'd say mortgage debt relative to the US? Or could it be that we're also more sensitive when it comes to debt?
Well, it used to be pretty much in line with the figure in the US. Canada's share of GDP based on residential investment is twice the size in the US. It's 10 here, 5 south. But it's the ownership transfer cost that has boomed recently in large part. And that's because the average price of a house in Toronto and in Vancouver, where we see the crunch of the housing market, has exploded, and now it's very high. So a share of these prices means higher costs for transactions. So that just blew that out of proportion. And of course, Canada is very sensitive to housing, because we have a lot of immigrants coming in the country. This is our secret weapon. Our population is growing fast because of immigration, and immigrants converge mostly towards Toronto and Vancouver, some Montreal, but mostly in those two regions. So you need to need to provide supply for these. So it's kind of a feature of the Canadian economy.
Now, I hate to bring that R word up because nobody likes to hear the R word, but are we headed for a recession, and would it be hard or soft?
Well, I think if we go into a recession, it's not going to be a hard one, because I think the bar is very high to see massive layoffs, both in Canada and the US, in an era of labor shortages. In Canada, we have about 0.75 job vacancies per unemployed. So there's a buffer there. And in the US, it's even larger. It's 2 job vacancies per unemployed person. So you have that buffer there. Probably this will shrink first before we start to see massive layoffs. And it's for recession odds, it's never 0 or 100. I would say in the US right now, where IA Financial Group is standing, it's about 60-70% odds of a recession south of the border. In Canada, we're still kind of on the fence at 50-50 by the end of 2023.
Okay, 20 seconds left until the next break. Bank of Canada, how many rate hikes do you expect this year?
I think we go all the way to 4%. This is what the market is pricing, so it wouldn't be a surprise. So likely it's going to be a 50 basis point rate hike at the next decision, and then a last one of 25 by the end of the year.
Okay, we'll take a quick break and we'll be back to continue this discussion. Welcome back to Strictly Money. I'm here with Sebastien Mc Mahon of IA Financial Group. Sebastien, let's switch gears and talk about markets. Bondholders are feeling a lot of pain. Bonds are in bear market territory. And as you noted in your weekly commentary, the first time in 30 years, what's your advice to them?
Well, if you need to invest in bonds, the good news is that rates have never been as high as right now. So now they're back as a strong option within a balanced portfolio, especially if you're nearing retirement and you need that income component in your portfolio. Well, you have something good there in terms of expected returns. Our fixed income team at IA Financial Group, the strategy that they're focusing on right now is buying on weakness. The team thinks that the 10-year, 30-year rate, likely they've hit levels that have become very interesting on a long-term basis, but also on a shorter-term tactical basis. So it's time for them to add, and they've been active recently in adding to the duration and to the size of our portfolios.
When investors look at bonds, what would you suggest? Should they be looking at individual bonds, or do bond funds make sense? Because I get that question quite a bit.
Yeah, I think bond funds always make sense. Ideally, you need to find active portfolio managers because there's a lot of action in the credit world, which is tightly linked to what's going on in equities. So you need a flexible team for that. Of course, we offer these kind of solutions, but what's going on in credit, what's going on with the yield curve, all of these aspects are moving so quickly that sending your money to a smart, active fund manager, I think it's the way to go rather than trying to build a portfolio yourself.
Okay. Canadian markets, they've certainly shown more resilience than the U.S. markets. And I know, all the strategists I have personally spoken to believe that the TSX will continue to outperform the U.S. markets. Do you see this, Sebastien, or is anything suggesting that that's changing?
No, I think the leadership and everywhere around the world remains in the energy sector. And in Canada, we have a very strong, a good one. It's a strong weight in the index. So I still think TSX is the way to go. But when you look at valuations, you see the US, the S&P 500, it's still trading at about 16.5 times earning as I look at this morning, which is pretty much more expensive than any other time in the last 20 years, except, let's say, the COVID period and the tail end of the dot-com bubble. So the US stock market right now is expensive on an historical and relative basis. When you look at Canada, you look at the TSX, it's trading at about 11.5, 12 times forward earnings, which is very low on a historical basis and on a relative basis. So if you're if you believe that energy will continue to lead the way, you want the TSX. If you're a value investor, you want the TSX. So there's many reasons to love the Canadian stock market as of the fall of 2022.
We know that TSX is heavily weighted, like you said, energy, as well as financials. So what's your take on financials with rates going up?
Financials remain solid. The recent earnings were good. We can trust the Canadian banks to deliver some good results. Of course, there's always some vulnerabilities in the economy that could factor in. But again, you're buying the TSX right now at a very cheap valuation. So you have this margin of safety that's already embedded in the price. So that doesn't really change our view.
Are the banks at all vulnerable to the housing market, or are they have solid reserves to handle?
Well, they do have solid reserves, but of course, when you see the price of existing houses rising by about 50% in the country since late 2019, you have to logically expect that you're going to give some of that back. So some households that maybe overextended themselves in late 2021, early 2022 by buying houses that were maybe putting the mortgage on 30 years, signing for a variable rate. So you have a pocket of households that are vulnerable here. This is true for all of the banks, but the state of the Canadian consumer remains pretty good. The debt liability, the liability ratio is still very interesting historically. So we're not thinking that there's a tidal wave of insolvencies coming here.
Okay, 20 seconds till the next break, Sebastien. For those who are holding on to cash still king. Would you recommend that they still do that?
I say tactically, cash is very interesting because this is a bear market that we're in. Bear markets are volatile, and at some point there's going to be a very interesting buying opportunity. So then it will be very good to have some cash on hand.
Okay, we'll be back in 2. Welcome back. Sebastien, before the break, we were talking about how cash is king for those who are on the sidelines with cash. So what signs are you now looking for that suggests that it could be a buying opportunity?
Well, you need to be patient first. So this is a bear market, and bear markets are processes. So typically, on average, and the average, of course, it's all over the place. But if you look at the average, it's about a year that the bear market lasts. Of course, we started in early January. That was the peak. So maybe we have a few more months to go if we're following the average bear market playbook. And in an average bear market, the market falls by about 30% on average, and we were at minus about 25 at the lows of June. So what we're looking for now is we're waiting for the signs that there's a recession or not. So of course we will know that likely after the fact officially, but the markets will start to price a recession when the indicators are pointing that way. Now the odds are rising, but we're not there yet. So the market still hasn't made up its mind. But interestingly, whether there's a recession or not, it matters a lot in a bear market. If there's no recession, likely we're just going to be moving sideways for a while and then start to recover. But since 1929, when there's a bear market and a recession, the markets tend to go much lower, to be much more volatile, to have a few bear market rallies that get stronger and stronger. I'm talking about 15-20% a clip before you finally make a bottom. But the short answer to all of this, typically in bear markets, the market tends to bottom around the economic data bottom. And looking at the chart we looked at earlier, maybe we still have a good few months ahead of us.
Sebastien, can you remind viewers too, which sectors typically bounce back first?
Well, the leaders tend to lead the way out of bear markets. So when you look at the leadership right now, the FANGs, so the tech, has not been a leader for a good while. It's the cyclicals and mostly the energy sector that have been the leaders. So we would expect them to remain leaders out of the way. After that, cyclicals should be leading the way there, but we do expect the value team to remain an important team going forward.
What are you expecting in terms of the upcoming earnings season and some of the trends that you're looking for? Things like, revisions of numbers down or layoffs or something else.
We're hearing a lot of companies talking about layoffs. It's small numbers, so it's not yet massive layoffs, but they are in the process of shrinking their workforce. Q2 was actually a pleasant surprise for earnings. So Q2 was stronger than we expected. But when we look out to 2023, we're already starting to see analysts revise lower the expectations for earnings. Typically, when there's a recession, earnings are will fall by about 15 to 30%. So if we're in the camp, let's say we're conservative here and say minus 15%, well, as of today, for the next 12 months, the analysts are still expecting growth in earnings of about 17%. So we need to go from plus 17 to maybe minus 10, minus 15. So we expect a lot of earnings revisions that could be negative, and that should weigh on market sentiment along the way. So it's a few earnings seasons ahead of us that could be at risk here.
Are you seeing evidence then, Sebastien, that companies are able to handle the higher inflation and they're absorbing it either through, cutting fat, if you can say that, or being able to pass on costs?
Well, Q2 showed us that, yes, that's still the case. Profit margins remain near all-time highs. It's logical to expect profit margins to come off of the highs and probably contract quite a bit before the end of 2023. So it's going to be a quarter by quarter story, but we do see that the PPI, the producer price index, is growing faster than the consumer price index. So this should bring mounting pressure on profit margins along the way.
Yeah, so I should remind people, right? PPI is more of a leading indicator because it's the price of manufacturing the goods. So that typically gets passed on to consumers, which is the CPI.
Yeah, exactly.
All right. Well, we really appreciate you coming on today. Thanks so much, Sebastien.
Always a pleasure.
And I want to remind viewers, for those of you who are watching, if you'd like to get Sebastien's weekly updates on the economy and markets, you can subscribe. We'll bring up the website link so you can see it there, ia.ca/economy. Sebastien, thanks again.
Thanks for having me.
We'll see you next time. Well, that does it for this show. Thanks for watching. Until next time, stay well, stay wise, stay well.